everyone, and welcome to another episode of the Cross Country Super Podcasts. And as always, I'm joined by Jemma Sanderson, all the way from Perth. How are you, Jemma? It's good to
I'm
see you.
I'm good, Darin. How are you? It's I look summery, don't I? I think it's supposed to be 38 degrees tomorrow in good old sunny Perth. So, um, just in time for before we run out of summer-ish weather, trip to the
Well,
beach.
that sounds tremendous. I think we're 27 here today in Sydney, so hopefully some of this warmer weather can continue because we really didn't have that much of a summer over here on the East Coast. But yeah, very pleasant outside, which is good.
Mm,
Always love the warmer weather. Hope it continues for a little bit longer.
just a little bit longer would be fantastic. I
Indeed.
agree.
And of course, this podcast is brought to you by SMSF Property Valuations. Need a current or retrospective SMSF property valuation? Whether it's for annual financial statements, pension commencement, or related party transactions, SMSF property valuations offer fast, reliable, and audit-ready reports across Australia. And I can never speak too highly of how important valuations are. And again, as we speed towards, obviously speeding towards the end of this financial year, but as we speed towards the implementation of the dreaded Division 296 tax,
296. Yeah.
valuations will become all that more important and a lot more focus will be brought upon them. But thankfully, we're not here to talk about Division 296 today because we've done a lot of talking about that and we don't want to talk about that for much longer. Not
Anymore.
right now,
Anymore.
anyway. I
No.
know that it's unrealistic to think that we won't be. Yes, we will be. I'm still writing articles about it. We've just come back from the SMSF Association National Conference for 2026. And guess what dominated discussions there? In fact, I think there were 4 or 5 sessions dedicated to the tax. So, um, yeah, a little bit Div 296 uh, exhausted,
Fatigue.
to be
Fatigue.
honest.
Totally.
Yeah,
And it's
fatigue.
just going to get worse because as we sit here right now, so this will indicate the day, the bill went through the House of Reps yesterday.
Yes,
So
yes, it did.
we're waiting impatiently or patiently for what that might look like. And I know we're not talking about that today, but it's quite interesting that it passed through without the regulations having been tabled or even drafted that we know of at this point. So anyway, we shall have to wait and see. And like you said, it really brings to the fore how important getting good valuations is going to be under this new regime.
Yeah, that is a really good point you make. I know we're not talking about this subject, but what about the regulations?
Mm.
You know, we're going to need those to figure out how it works. Crickets at the moment,
Crickets, yeah,
so your guess is as good as mine, but no doubt we will do a podcast once all of this is
yeah,
finalized to fill you in on all of the little details. I'm expecting there still to be tweaks.
lots of
Um,
them, I think too. Yeah,
again, the more analysis you hear, the more things are coming out of the closet and being uncovered to say that, well, this is actually, we just realized this is an issue or that's an issue. So, how all of that is resolved, I don't know. And that is a podcast for another
for
day, no
another
doubt.
day. And if
But we're
someone
not.
does, it does really want to listen to Div 296. We've done, I think, four of our sessions have been on Div 296. The early ones, ignore them because they're on the old rules.
Well,
But the
they're
more recent
obsolete
ones
now.
have certainly been on what's happening in the new one. And yeah, again, there has been some slight tweaks since then. Anyway, let's move on to what we're talking about today,
Well,
Darin.
we're talking about something more positive today, which is very nice because, it's a bit of an uplift. We like that, a bit of a positive vibe. And that is, it was confirmed last week, I think it was, that the concessional contributions caps will be increasing as of the 1st of July this year. Now, there had been speculation and forecasts that it would be increasing at that point in time. But of course, you've got to wait till the economic statistics come out before you can actually
Mm.
confirm it. And it has come out. I'm not going to go into great detail about that, but as we know, the indexation of the concessional contributions caps are based on a watty, or as Gemma, you mentioned, if you refer to different people, they call it a wote.
A wote, a
A
wote,
wote,
a
sorry, a
wote, a
wote,
wote,
a
a
wote,
watty. Yeah.
a
It's a
wote,
bit like
which is,
gnarly.
yeah,
Gnarly's got different pronunciations of the various acronyms there. So anyway, so
which
yeah,
actually
it's a good.
it stands for average weekly ordinary times earnings. Did
Yeah,
I get that right?
yeah, you did get that right. You nailed it.
So
Yeah, that's right.
obviously a bit of a mouthful that one. So a watty, a woke, sorry, not a woke, a wote. Um, Whatever's easiest.
A
That
woty.
that
Anyway, all of
the
those.
full name is a bit of a mouthful, and we don't
Yeah,
want to keep referring it to that to it as that. But those figures came out, and that confirmed that the concessional contributions cap will be increasing from the 1st of July from its current level of $30,000 per year to $32,500 per year. And of course, that means that there's all these flow-on effects as to the rest of the contributions.
yeah, that's right. So we've got so it's it's one of those things where we knew the transfer balance cap was being indexed, so we'll talk about that too. And that's at CPI, and those figures come out towards the end of last calendar year, but then we have to wait till the end of February to get the official things for the contribution caps. It's one of those things that's always dumbfounded a lot of people in the industry as to why some things are indexed at CPI and why others are at AWATI, AWOT, whatever. But it's across the board, loads of tax thresholds and things like that are at different things. And so we just have to deal with it. So yeah, the concessional cap, that as a baseline, that has that big flow on effect. So a couple of things there. Obviously, what you can contribute from a concessional perspective. And then the non-concessional cap is 4 times the concessional cap. So that's now going to go up to $130,000 as the single year, 260 as the 2 year, and then 390 as the 3 year. So that's a nice increase there for some people. But then of course that impacts with the transfer balance cap being indexed and the contribution caps coming through. We've also got different scales for non-concessional contributions in the new financial year. And it is around this time of the year that a lot of people in their lead up to what do we do before 30 June? Do we make contributions? Do we wait? Do we do a single year this year and then do our 3 years next year? And that could ultimately, if you were sitting here today, by 1 July, you can have over $500,000 as a non-concessional contribution basically landing in your super account if you're eligible with your total super balance. So it's it's positive news, like you said, and because it only was indexed by 2,500, the concessional cap, but again, that all just gets compounded as it flows up through the mix. So yeah, a good outcome. And now we just have to consider sometimes with the strategies that we might have already recommended for clients. Do we wait? Do we top people up now? What does that all look like? And then the other thing with all of this is you want to try and get as much money into super as you possibly can. We have the resources.
Mm.
So what does that look like? And then we've got the
Yeah.
carry forward concessional caps as well.
Yes.
So
Yes.
the you've got, so that's the current year and the previous 5. So in the 25-26 year, you look at that cap and the previous 5 years, it's actually $167,500 that if you had no contributions over the period from 1 July 2020 until basically 30 June 26. So it's the current year and the previous 5. So basically over 6 years, it's 167,500 that you could contribute to super, claim a tax deduction for, as long as you had enough taxable income. And you wouldn't be in excess of your concessional cap. Next year, what will happen is the 2020-2021 cap will drop off. And it'll be the 26-27 cap of 32.5 and then dropping down for the previous 5 years, so from 1 July 21, and that enables the total amount across those years is 175,000. So it is that step up, and that's because of the way the indexation has worked historically. We've now next year we won't have a $25,000 amount that was a previous cap. It'll be 27 and a half going up. So that's where it's an extra, $7,500 from the current year's one. So anyway, it all has that flow on effect.
Yeah, it's a bit of a weird one, that bring forward rule where you can carry forward any unused concessional cap from the previous 5 years, but it's a weird number. And the number that you quoted does sound a little bit weird because
Mm.
we do tend to talk in whole amounts, I suppose you can say, or easy or well-rounded amounts. But the further you get into that, the more number of caps, different
Yes,
caps is
they're
included
different.
in that,
Yeah.
just to be a little bit confusing. So, whatever happened 5 years ago with the concessional cap, that's still the limit that's applied to that financial year's carry forward allowance,
Yep.
um, which is why you
And then
get.
the other thing with that I often get people are like, right, well, I want to use so if it's right now, we're in 25, 26, I want to use my cap from 2020, 2021, because I had the whole amount available because maybe they were overseas or they weren't working that year. They could have been on parental leave or something. Anyway, they're getting a big distribution or a profitable year, big capital gain on the sale of an investment property or some shares or something. Let's make a contribution to super and claim a tax deduction. But how about I just use that year's limit? Well, the only way that you can only use that limit, it automatically goes back to the furthest away from where you are. But in order to use that, you have to go over the current year's cap. So if you had 25 available from 2021 and then your current year is 30, you actually, to fully use the 25, you have to put in 55. So the 30 for the current year. So you're over, and then that will go back and grab that one from back there. So you can't just say, oh, well, I've put in 30 and I'll use 25 from here and 5 from that year. No, that's not how it works.
Yeah, it's not, as I said, very powerful tool, but certainly not
Yeah.
as simplistic as you might think when
Yeah.
you're starting to look at using these things. And of course, as you say, Gemma, always the current year first,
Yeah.
and then we figure out what to do after that.
And then
Which,
the other thing with
yeah,
that is people forget that that is their cap for the year. And so they're subject to Div 293 tax if that's applicable to them because they've got that adjusted taxable income over 250, which is a threshold that is not indexed. So when we talk about indexation, the whole some are indexed, some aren't. And it's really interesting when you reflect back on thresholds that have been indexed and those that haven't. For example, the 250 for Div 293. We've got some small business concessions thresholds that haven't been indexed since 2007.
hmm.
So that's quite astronomical, in my opinion, when you think about where they could be right now, because we've got other caps like the CGT cap for. So there's two CGT caps. I'm going to launch straight into it, Darin. So there's two CGT caps. So I'm talking about contributions. I'm going to be all over the place today, but there's no difference to every other time we have a chat. So there's a CGT cap, one that where if you make a contribution to super, the retirement exemption, you can have up to $500,000 where you're exempt from CGT on the sale of a small business. Now you have to be eligible under the small business concessions, and they're quite nuanced and difficult to even get through that barrier to fall into whether you can use this or not. And that's up to $500,000 that's available. Now, you don't have to contribute that to super if you're over a certain age, but a lot of people like to because that's a way for them to get an amount into super. So that's $500,000, up to $500,000 that you can basically use against a capital gain. That hasn't been indexed since 2007, if not before that. But there's a CGT cap contribution amount, that includes that 500, but also applies to if you have an asset that is pre-CGT. So you've got to be eligible for the concessions to start with, the small business CGT concessions. You've held the asset and it's either pre-CGT or for more than 15 years, then you've got a higher cap that you can use there. And that has been indexed. That started at $1 million at 1 July 2017 and is now 1.935 million. So you could see there, if that 500,000 had been equivalently indexed, it'd be a lot more now. Anyway, that's just one example of what that indexation looks like. And the 1935 is next year. This year it's 1865. So just in terms of people wanting to make contributions and top up from that perspective.
Yeah, really easy.
Yeah.
Got that all
Simples.
memorized. Yeah, got that all
Simples.
memorized.
Simples.
Straight
Yeah.
away. Straight away,
Yeah.
Jim. All
Straight
over.
away. Yeah.
Yeah.
So the thing with the non-concessional caps, we've got, so at the moment with a $2 million transfer balance cap,
Oh,
the way that the thresholds then work is it's the general transfer balance cap, the general transfer balance cap less the single year cap, so 120. So that gives us our second threshold there of the 1.88 million. So if you're between 1.88 and 2 million total super balance at 30 June 2025, then you've got an available cap of 120. If you were, then the next threshold down, the 1.76 million, is the $2 million transfer balance cap less the 2-year threshold or non-concessional cap threshold of 240 gets us our 1.76. So between 1.76 and 1.88, if that's what your total super balance was at 30 June 2025, then you can put in 240. And if you're under 1.76 at 30 June 25, you can put in 360, subject to your contribution history. And also, if you're over 75, you can't do it. That's this year.
yeah.
And then next year, now we've got 2.1 is our transfer balance cap. So that was released late last year, that was being indexed from, because that's indexed in $100,000 increments. So that's going up to 2.1. Then with the new non-concessional cap, the single year being 130, then 2.1 less 130 gives us 1.97. That's going to be our second tier. Then we've got 2.1 less 260 gives us got to get this right, 84. And then under 1.84 million total super balance at 1 July or 30 June 2026, you can make the $390,000 contribution, again, subject to contribution history and making sure you're not over 75. And
Yeah,
I'll take a
so
breath.
it's a very good point, Gemma, and we do always talk about this, and it's mainly because we go off piste in our
Off piste a lot.
discussion
Yeah.
so much. But whenever a change like this happens, you can actually see how all of the elements, or not all, but some of the elements, critical elements, interact with one another once there is a change. I mean, if you're to look at something in isolation, say the indexation of the transfer balance cap, you wouldn't necessarily think that that had anything to do with contributions or, you know, trigger the likelihood of having to revise your contribution strategy towards the end of the year, but
Mm,
it's all
absolutely.
intertwined. And it does get a bit confusing because it's got so many implications, widespread implications that are not obvious on face value. But again, situations like this illustrates it perfectly how simpler super is not actually that simple.
No, it's not. And I mean, the challenging one with so the transfer balance cap and the contribution caps, everyone thinks that they do interact. They only interact because of that top line number of
Yes.
the
Yeah.
2.1 or the 2. And so it's the general transfer balance cap, and then things tier down from there. So a lot of people think, oh, I've fully used my transfer balance cap because they started a pension however long ago. And so therefore, I can't put contributions in. It's like, no, 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 no. What is your total super balance? If your total super balance is within those tiers, whether it's this year or next year, and you've got the age bits right, then you could be eligible to put in contributions. Now, it might be, well, I don't have spare cash lying around, don't have that spare 390 lying around. Okay, no worries. Why don't we do a withdrawal and recontribution strategy? So it's putting in place those sorts of, like, it's just thinking more holistically, I guess, about what those options and strategies might look like. Is the bring forward resetting next year, and therefore it's a 390? Maybe it's an opportunity to move money from the higher balance spouse to the lower balance spouse. You might not have any, again, spare money lying around outside super, but let's use the super for its utmost. The other thing that I have seen people do is they pull the money out of super before 30 June. So at 30 June, their total super balance reflects that withdrawal, which then means they can put it back in as a contribution. So there's various little elements like that, of course, on the basis that they're eligible to take money out of super. So it can't just be, I'm in my 40s and I want to try and rejig the balances. No, you've got to be eligible to take money out.
I suppose while we're still on the positive note,
Yeah,
maybe Division 296 might bring people's focus on how the total super balance works a little bit more.
yeah,
Only
definitely.
because there's so much focus on it, and we've been talking about the total super balance for so long, 2.5 years or
Yeah,
close to 3 years, with this new proposed tax. So maybe, you know, the cogs in people's mind will actually understand a little bit better how the total super balance works in all facets, not obviously just the Division 296 one, because they'll be concentrating so heavily on it.
yeah.
It might actually uncover that, oh, right, yeah, I get it now, that it's all,
The light
it's
bulb moment,
all
the light
linked,
bulb moment.
which
Yeah.
is, I mean, it's a bit perverse. And
Well, it's quite good that, again, we're not talking about Div 296, but total super balance. The new rules have a revised definition of total super balance. So that I think is excellent, because previously or currently, until it passes, the consideration it was the transfer balance cap amount, but then that was adjusted for account balances. And the reason why that was um, included, it was because of defined benefit schemes. So it just enabled that what the transfer balance cap amount was for a defined benefit scheme to sort of be factored in. But now those are going to have to be valued on a yearly basis using the family law regulations. So it's that they've removed that basically entirely, and that's a good outcome, in my opinion, from that perspective, because again, it bred a lot of misunderstanding about things. But the other consideration with that, if we're just talking about total super balance, and then I'm going to talk about Div 296 for a sec, is so there's certain excluded interests or excluded earnings from Div 296. So if you've got a defined benefit like a judge's pension or it's a constitutionally protected fund, earnings on those are excluded from the super earnings or the relevant super earnings that might be captured by Div 296. But the total super balance of that account is captured in terms of determining if you've got another super interest. So, say you've got an SMSF, it's worth $1 million, but then you've got a judge's pension over here that the factors determine is worth $3 million. So, your total super balance is 4 million. The earnings on the judge's pension are excluded from the calculation, but the earnings in that SMSF, the taxable income with the adjustments, whatever that looks like, they are included in that calculation. And the total super balance, so the $4 million is the total super balance for the purposes of the Div 296 tax on the earnings on the $1 million SMSF. So it is going to be, that total super balance is absolutely going to become a very vital consideration. And stop talking about Div 296 now for probably a couple of
indeed,
minutes.
yeah, that's all right.
Yeah.
It's so ingrained in our brains at the
It
moment.
is. It is. Now, the other thing
It's
I did
almost
want to,
difficult not to do that.
I know, the other thing I did want to remind people, which I didn't address when we were talking about the carry forward concessional, is that those carry forwards are only available if the person's total super balance at the previous 30 June is less than $500,000, which is an unindexed threshold.
That's right. That
So,
hasn't
uh,
changed either.
No, that hasn't changed. Now, again, if in the situation that say someone at 30 June 25, they had 550, and so therefore they can't use it in the current year because they're over 500,000, but they might still have that unused history sitting there. Then let's say the balance goes down because of markets or bloody blah, whatever, and it goes below at 30 June 26, then they can still use it in the following year. So if you at any point you go over 500,000, it doesn't drop you off the cliff for not being able to use those provisions. It's just that it's got to drop below 500,000 at a future year, and then you can still use them. Now we
Yeah.
also have to be careful there if someone is getting older and they want to make a contribution and claim a tax deduction for it, then if they're over 67, they have to meet a work test in that relevant year. So it's again, there's lots of different factors that all feed into how this all works, and then obviously the thresholds and the indexation of them have an impact on what you can and what you can contribute and not have an excess. So again, I want to emphasize that you can make a contribution of $1 million if you want, but there'll be an excess that needs to be dealt with.
Yeah, yeah, yeah. And no doubt, I believe this has already been written about in the AFR this week or last week upon the news of the concessional caps increasing, that people will maybe be looking to take advantage because of the increase, the extra $2,500 of doing a contribution reserving strategy
Mm,
into the
yep,
next year because you've got that little bit of a bonus um, that straddles this
the two
financial year.
years. Yeah.
Yeah.
So the challenge, so that would be a 200,000 that someone could put in this year if they had that carry forward and they could reserve. Or, the tax office doesn't call it a reserve. Oh, goodness,
No,
I've got a
no,
fire
no,
alarm that's
no.
about
We
to start.
cannot. We can't. We can't call it a reserve because
No,
reserves aren't allowed in SMSS anymore.
no,
What do we
that's right.
call it? Well, it kind of. If you're an
It's called a
accountant,
suspense account.
yeah,
It's
it
a
acts like
suspense
a
account.
suspense account, doesn't
Yeah.
it?
Now,
We do refer
apologize,
to
Darin.
it.
I might get a fire alarm happening in a sec because I'm just doing a
Oh,
test. So
I thought
if
you
you can
meant the
hear that.
fire alarm was going to go off because we use the word reserve when we
Ah,
shouldn't.
no. We're
A
going to be
little bit
arrested.
like we're not allowed to use asset reset,
Yes.
CGT reset with
No,
it's
exactly.
an adjustment. It's not a
It's an
reset. We're not
adjustment.
allowed to
That's
call it
exactly
a
right.
reset,
No.
just as we're not allowed to call this a reserve.
Yeah. So you could have your suspense account, and
Yes.
that would work. SMSFs are where that obviously works, and but it has to be a separate contribution in June in order for you to hold it in suspense until the 28th of July in the new year where that falls out. Now, the challenge with that is someone might be looking to do that. And if they're not working, that would be fine. But if they move across, if they start working in the new year, then they're going to potentially have an excess in that year because the super guarantee has to be paid. And that's the other thing with the index of the threshold, the way that the maximum contribution base and all of that sort of works. So in the current year, we've got a $30,000 contribution cap. And so the consideration with that, and I've just got to get my calculator out to get the right outcome here. So the maximum contribution base is a certain amount per quarter that an employer has an obligation to pay, and that gets indexed each year. However, over the course of the whole year, that's capped at whatever the concessional cap is. So because the SG rate went up and is now at 12%, then the maximum contribution base actually ended up going down because if you did 12% of what that amount was, you would end up more than 30. So you'd have an excess. So at the moment, it's a $30,000 divided by 4 quarterly maximum contribution base. And then in the new year, it'll be the 32 and a half. So the expectation is that will just, the maximum contribution base top one will that will continue to go up, but because it's 12%, and the way the concessional cap, I would expect that the concessional cap will be what that is for the next few years. But because as the cap increases as well as the maximum contribution base, and the 12% isn't going any higher, then it might end up getting up there where it does change a little bit. So anyway, that's another thing for people to be aware of from that perspective.
So many things to consider here. There's
Mm.
literally a myriad of things when you're looking at reviewing your contribution strategy when there is an indexation change to the caps. I suppose one thing to really highlight is that obviously you can't do the suspense strategy uh, before June. You
Yes,
can
in any
only
other
do
month
it
other than
because it
June. Yep.
straddles the two financial years. That's really important. And as you probably highlighted there, Gemma, that you can't once you've taken advantage of that, that's it for you for the next income year. You can't,
Unless you do it again, you've
yeah,
almost then can do it. You get a benefit of it in the first year because you
yeah,
get to double dip, but then every subsequent year you can only single dip, and you've got to do it in June. So by all means double dip, but then in terms of the next year, you're not going to get a deduction unless you do another June suspense, and then you keep that carrying on
yeah,
into the future.
yeah.
Yep.
So it's just something to take into account that you have used you have used that up for the subsequent financial year. So there's no, oh, I can just keep doing this. Hey,
Yeah,
isn't this I can
keep
just keep
going
doing
as you
this.
are. Yep.
No, no, not quite. And the other really good point you raise, Gemma, is that whenever there is an indexation, if you have any sort of salary sacrifice
Yep.
arrangements going on, this is the time to revisit because the last thing you want to do, obviously, is to do a set, well, think that it's a set and forget. The parameters change, and then you find that you've got an excess.
Exactly. And an excess is manageable. It's not like it used to be where it was potentially at, there was a 95% potential tax rate on an excess concessional back in the day. I'm talking 2007. God, that's grim, isn't it? So a very, very long time ago, that all got revised, and now we have the mechanism to deal with things. So that's good. The other thing that people need to be aware of is if you use your carry forward and do the suspense account consideration, generally that is a personal deductible contribution, or maybe your salary sacrifice, a bonus or something like that, or your June pay that happens at that time. And then in the following year, if you are still getting SG, there is the ability for you to opt out of the SG, but this isn't the mechanism that will allow that, because the SG, that your employer still has the obligation for that year. So you can't say, well, if the SG is going to push me over the cap because I've got other employments that's going to do it. You made a personal contribution and used your cap last year for this year, sort of thing. Yeah, that wouldn't give you the mechanism to be able to sort of opt out of SG from that perspective. So yeah,
Yes,
just to watch out for
so
those
many. I
sorts of
mean,
things.
this literally is. I feel like we literally are unpeeling several layers of the onion
Players, yeah,
as
we
we
are.
as we continue to speak. Now, when we talk about that suspense strategy,
Yep,
we're talking about bringing forward the concessional contributions cap
for
for
next year. Yep,
the subsequent year. I suppose if we're looking at revising contribution strategies for non-concessional contributions, it's almost the other way around, whereby
yep,
whereby you've got to maybe contemplate delaying
yeah,
a particular
contributions. Yep,
strategy to wait until after 1 July, obviously, to get the higher amount.
yep. And so this again, like I said at the start, I think some at this time of the year, the considerations are: do I do 360? I've got 360 sitting there. Maybe I've got more. Maybe I've got $1 million and I want to contribute it into super. I could put in 360 now because my total super balance at 30 June 2025 is under 1.76 million. Okay, great, Darin. Let's do it. Well, hang on a sec. Within a very short period of time, within 4 months, 5 months, we're going to have the situation that the cap is 390. So depending on your total super balance at 30 June 25, if that was $1 million, if you put in 120 now, unless your investments go bazinga, up substantially, you're not going to be over the new lower tiered cap there of 1.84 that will prevent you from putting in 390 in the new year. So again, your 390 plus your 120, there's $510,000 within a very short period of time that you've been able to swing into super as a contribution. So that I think that that's quite a worthwhile strategy for people to look at. Obviously, the situations where it won't work is, let's say your total super balance at 30 June 25 was 1.7 million. And as you sit now, you're like, right, do I do 360? Do I do 120? What do I do? Let's say it's worth 1.85 million or 1.9 million because it's just gone up in value over the course of the year. And then you're putting in a concessional. And if you did throw in your 120, then you might end up being too far over these limits. So you wouldn't just do 120 plus and wait and think, oh, I can do my 390 in the new year. By the time you hit 30 June 26, you might end up being way over the 2.1. So you can't really top up. So in the lead up to 30 June 26, you might be looking at, look, I've got to do 360 because I'm not going to be able to put more money in next year. I've got to do it this year because my total super balance at 1 July 25 is allowing me to do 360. If I wait to do more in the new financial year, then I'm out. So that's worthwhile having a
Yeah,
consideration.
it's a situation where everybody's got to monitor their own individual
Mm.
set of circumstances to be able to figure out exactly what strategy will work for them. I mean,
Yeah,
on face value, I think what you said about the $1 million, that makes a hell of a lot of sense, doesn't it?
yeah,
You're
yeah.
not gonna want to forego the extra amount that
The
you can
extra little
get
bit
into
that you can put in
super
such a
just
short period of
because,
time.
yeah,
That's right.
just because you mistimed when you did it, and
Mm,
then oh damn, I missed out on the
missed
opportunity.
out. Yeah.
You don't want to do that.
The other consideration which I've just seen recently is someone made a large contribution to super in the 23-24 year. Got to get my timing right here. 23-24. Yeah, 23-24, with the intention of claiming that as a tax deduction. But then the process wasn't followed to do so in time. And so that was then classified as a non-concessional contribution. Now that was the full carry forward at the time was about 157 odd thousand. So that would have triggered a bring forward period triggered back then. So if I'm looking at it now in 25, 26, going, oh, let's do a 120, let's do a 390 because I've got the cash available. And then I'm thinking, oh, bugger, like what happened there? I look back, oh, you put in 157 and a half. Your cap back then was 330. You've got an extra amount that you can put in of like it's not 120 this year, then 390. It's 170 odd thousand now, and then 390 in the new year. So always look back further than just with your blinkers on. Always go back further because you just never know if a contribution was someone serving out a bring forward period. Did they trigger a bring forward? When was that? When will it expire? Etc. Etc.
Yeah, it's difficult because if it doesn't matter whether or not if you voluntarily use the bring forward provisions, then obviously you should be conscious of the fact that you've done it. The
But you'll
difficulty,
forget. People forget.
yeah, that's true, but yeah, but it does mean that you're locked in for that 3 year period, which
Mm.
means that you can't just on a whim say that, hey Gemma, I read that the contributions caps are going up from 1 July. Let's do some bring
Let's
forward
throw some more money
things,
in. Yep.
but you can say, yeah, but Darin, don't you remember you already did that 2 years ago, which means that you can't move on that until
Yeah.
that time period's expired, before we can start talking about the next level of what your contribution strategy is going to be. But I think the most difficult one is when it's inadvertent.
Mm.
And obviously, that's the way the tax office treats it, that if it does go over, they just say, right, well, you've triggered a bring forward and that's it. You
Yep.
might not even know about that. I think a shout out to Craig Day. He's got a great example of when people
Sense.
report cents, yeah,
Yeah.
cents
Sense.
over it. And the ATO can only really look at round numbers, but they take into account the cents, and the cents triggers the bring forward
Yeah. Well, because
rules.
in the personal tax return, it's rounded, but in the super fund, it's cents. Well, it's the other way around. I always get this wrong. Anyway, because one is rounded or one
Yeah,
doesn't include cents and the other one does. So it's not rounded. You just drop off the cents.
yeah,
Then those cents, and it's a mismatch. But yeah, those cents get captured. And then, yeah, it's if you're over 120 and 120,000 and 1 cent, it's ridiculous, but it triggers it because that's how it works. Again, thankfully, we don't have as horrible, the really, really horrible situation pre 2011 when, or 2013, one of the two, when they changed the rules. Where if you, so let's say you put in 120,000 and 1 cent this year, thinking, oh, I've triggered my bring forward, and that 1 cent was treated as a non-concessional contribution because for some reason you went put 30,000 and 1 cent in as a concessional, but then you didn't claim the 1 cent, you only claimed the 30. So the 1 cent became a non-concessional. You put in your 120 and then you've triggered your bring forward in that year, which means you're limited to 360 in 25, 26, 26, 27, 27, 28. But you're thinking, oh, I'm sweet. And you put in 390, you're going to have a $210,000 excess. Is that right? Over that period. That's not right. Yeah, whatever it is, something like that. Um,
well, the principle is exactly that, and I know that he's raised it a few times because
yeah,
he's actually had actual situations where, what is it, 27 cents or something has made the difference.
yeah,
And then later on down the track, clients are ringing up to say, hey, I got this excess contribution notification. What's this about? I haven't exceeded anything like that. And it is because of this. And yes, the rules are a little bit more fair in terms of any sort of penalties that are levied towards SMSF members or trustees now, as opposed to what they were before. It doesn't change the fact that, and I put myself in this situation, it can be a bit distressing when you get a letter from the tax office.
oh, notice saying
It's
you've
not, it's not anything particularly egregious or bad,
no,
but just the holy crap, I've got something from the tax office here. Like, what am I up for? What have I done
yeah,
wrong? Are they going to be knocking on my front door? Like that's a knee jerk, but natural
it's what
reaction
happens.
because we
Yeah.
don't, as individuals, we're not really, you know,
A tax office letter
prepared.
is
No, we're
scary.
not prepared for it because the
Yeah.
thing that you see is like, oh my God, the tax office has contacted me.
Mm.
What's this about? What do I have to
Because
get
a
back?
lot of back in the day when there were checks and you got your tax refund check, you would have loved a letter from the tax office. Now it's like, ugh, I've got a letter from the tax office.
Yeah.
What do I got to pay? Unless it's just tell you, here's your notice of assessment and here's your refund, and you're like, yes, but you've already received it in your bank account. Then yeah, everything like that is not great. But again, the fact that they've sort of fixed the mechanism for dealing with an excess, it's far superior than what it was. There's still a penalty, a bit of tax on associated earnings with respect to an excess non-concessional, but other than that, it's all pretty good. So contributions. That's really the consideration, I think, for this financial year. Like from a tax planning perspective, do we top people up or contribution planning? So are we topping someone up this year, or do we wait for the new year? Do we pull back and do 120 this year, 390 next year? And it's one of those things where you're just going to have to monitor it all the way up to 30 June 26 and look at how that flows. Now, that is obviously a challenge if the fund has, I'll call them non-vanilla and they're not listed assets. So you can get the price of any listed share on a daily basis. And ETFs and things like that, that all comes through. Managed funds, you can look that up. But if it's an unlisted trust, like a property trust, or if it's a direct property itself, again, you've probably got a good indication, but it quite different. And then you've just got to, again, brings to the fore that comment I made earlier about valuations and things like that. So it's worthwhile making sure that clients are aware of it and really optimizing what those strategies are, because notwithstanding Div 296 tax is coming in, well, that's the expectation. The sort of strategies we're talking about here, concessional contributions is one thing. That's just a single, for someone who's in a Division 296, if they're in scope there, what we're talking about here with non-concessionals is totally irrelevant because they've got too much money in super, or they're well over the thresholds. So it's the valuation piece there is making sure that from a transfer balance cap, smack Jemma, total super balance perspective, they're falling under all of those. So again, total super balance, just such a vital concept.
Oh, indeed, and obviously going to get more vital now. Just a last point. I know one of the things that Craig does talk about in that whole rounding sense. The ATO used to have discretion, de
Yes,
minimis
the de
discretion, where
minimis. Yep,
they could just kind of ignore that as an
yep.
error. They don't have that anymore. So
No,
the gravity of sense uh, has really come to the fore now.
yeah, it has. It has. So again, we've just something else that we need to watch out for from that perspective. So like contribution strategies worth a revisit with the indexation happening. And I mean, at the time we're recording this, it's March. When it comes out, it'll probably be April. So we're nudging the end of the financial year. It'll be here before we know it. So it's important to have those conversations with people. So even then, notwithstanding that Div 296 is on the horizon, we're talking about people that are not in scope of that yet. It's still really worthwhile getting as much money into super as you possibly can, because it's still like the best structure out there. From that perspective, and longer term, looking at that, and that probably dovetails well into the impact of the transfer balance cap being indexed as well. So um, it's the benchmark for total super balance, the tiers, the threshold tiers there for non-concessional contributions. But then also that being index is the amount of retirement phase balances that people can have in super. Now, the challenging thing with this, not challenging, but sometimes misunderstood, not by advisors though, generally, just some clients often will say, oh, well, I started at 1.6 and it's 2.1. Can I put in another 500 grand into pension phase? And the answer to that is unfortunately no, because if you've fully used your transfer balance cap historically, then the indexation you don't get the benefit of. It's only if you haven't fully used your transfer balance cap historically that the unused component, the proportion that's calculated, you can get the benefit of the indexation. So if we look at someone, I'm going to use some easy numbers. So if they used 1.2 million of their 1.6, so that's a quarter. So the way it works is you figure out the used portion, that then gets rounded down to the nearest whole number, and then the unused portion is one less that proportion. So it's sort of like the unused portion gets rounded up to the nearest whole percentage, if that makes sense. So here we've used 75%, so we've got 25% left. So when it goes from so say the person started their pension with 1.2 and it's now nearly 10 years later, and they might have received a reversionary pension, or they're a death benefit pension recipient from their spouse. So the consideration there is, or they've made a downsizer contribution, etc. How much can they put back into into a new retirement phase pension? Now they've got their original unused amount of 400,000, and then of the indexed amount, they've got 25% of it. So they didn't use 25% originally. So of any indexed amount, they've got 25%. So 25% of 500,000, so an extra 125,000, as well as the 400 they didn't originally use. I've probably made an absolute meal of that explanation. So 525,000 they could put then or have in extra pension from that perspective.
Yeah, people have just got to remember that it's just proportionately
Mm.
um, allocated, I suppose you could say, whereby how much of the transfer balance cap have you used up?
Yeah.
Basically, if it's 90%, then you only get 10% of the indexed amount.
Next,
So that would be what, $10,000 of a hundred
50 grand.
thousand dollar
Yeah. So
of a
you'd have
hundred
of
thousand dollar
500. Yeah.
interest. So
Yeah.
unfortunately, with this one, while we've been very positive, obviously, about the contributions caps of allowing you to put more money into super, the indexation of the transfer balance cap is not such of a win
As
for,
awesome. It's still
yeah.
a win.
I
It's
mean,
a
it
win
can
for
be
people going into new pensions.
correct.
So
So
for in
yeah,
the new financial year, so they can just put in an extra 100,000. And the consideration, like at this time of the year, is okay, I'm eligible. I've just turned 60 and I'm retired, or I've just turned 65 and I've retired, or I'm over 60 and I've retired and I want to start. I can now start a proper retirement phase pension. Do I do it now, or do I wait and do it at 1 July? Because it's 100 grand more. So how does that all get weighed up from that perspective? And so that's where you have to run the numbers, and you're making a call then on if you start it now at 2 million, that it'll be worth more than 2.1 by 1 July 2026. You might not care. You might be like, right, I'm starting my pension. I want tax exemptions on that money from that date for the balance of the financial year. And so, the benefit I'm going to get there, plus the increase in value, I know I've got to take out a minimum, but I'm going to be better off longer term by doing that. Now, I know Meg Heffron, she's run a lot of numbers on all of that. And I'm probably talking out of turn here. I feel like comprehensively she said that you're better off just starting it now, not waiting, unless it's the 30th of June or maybe the 1st
yeah,
of June or
yeah.
something like that.
It's a tough one, isn't it? But again, it
Mm.
depends on the individual's set of
And how the money's
circumstances.
invested. They
Yeah.
might not even be worthwhile starting a pension because they don't generate any taxable income. So just sit it there and you could take down some draw if it's got cash sitting in it, not much taxable income, take the drawdowns. Anyway, everyone's different. And again, you've got to run the numbers from that perspective. But it's always at a threshold being indexed is always got some benefit. If you've already fully used it, then no. There is a benefit, so where the unused bit, you get the full amount each time it gets indexed, is with respect to the defined benefit or the constitutionally protected funds. So that's going to be up there at 1.935 next year. And it means that that's an extra full amount that you can then transfer out of one of those funds where without going over your that untaxed plan cap. Because if you go over your untaxed plan cap, it's taxed at the highest marginal rate. So there is some elements there that are worthwhile for those people. And whilst I'm on defined benefits, the other one is with the transfer balance cap going up to a 2.1, that means that the cap defined benefit income stream threshold, so this is the amount that you can receive from, say, a market link pension or a complying pension, or again, I'll call it the legacy pensions that you can receive from a legacy pension, and it's 131,250 next year because it's 2.1 million divided by 16. And that is how much you can receive that's tax free. Any amount you receive above that, 50% of it is taxed at the highest marginal tax rate. And I know that there's probably not that many of those defined benefit pensions still knocking around that'd be at that sort of level, but they're also worth a consideration in light of the Division 296 tax being implemented as well, where there's a reserve in there, so where it's still a complying pension.
Yeah, I suppose just about everything we've been talking about today. And as far as indexation goes, it's all about timing. We've been
Mm,
talking about timing the whole way through, haven't we?
yep.
Regardless of what aspect, be it contributions, be it starting a pension, it's really all about timing to see how you can make the situation most advantageous for you. And as you say, Gemma, there's a lot of sort of calculations that need to be done, particularly
Mm,
with the starting of the pension strategy. But it all revolves around timing and how you can time your strategy to make the most out of some of these indexation measures.
Absolutely, but it's also a little bit of crystal ball gazing. So you're thinking, do I? If I start my, I've got to. If I want to start my pension now, I've got to start it now. I've got to take out a prorated minimum, and so I'm making the call that I'm going to be better off by doing that now with the exemptions. Hopefully, it goes up in value. The earnings on that, I'm going to be better off by doing that now rather than waiting. Because if you did it now and say you've got $3 million in super and you're doing 2 million now, so 2/3 of your account goes into pension and 1/3 is in accumulation, and then you get to 30 June 26 and you did 2.1 and it's worth 3. So instead of it being 2/3 in pension, it would be 70% in pension. Is that increment, enough for the longer term? If it goes down in value, what's that looking like? Again, you're crystal ball gazing a little bit on, are you going to be better off by doing something now when you don't know what the future holds? And especially at the, right now, again, as we talk, we're dealing with wars and things like that all happening. So the impact that might have on market values, who knows? It might be have very little impact or it might have a substantial impact. So it's I keep doing this. My children are into that bloody
Oh
six seven
no,
thing
not
and I
six,
still
seven.
don't know what
Oh
that is. I still don't know what it is.
no, no,
But I'm
no,
like, on balance,
no.
you've got to figure out how that flows out.
I
So
didn't. I think I first came across 6, 7 when I saw David Warner scored 100 in the BBL,
oh yeah, he
and
did it for his kids or
when he got
something.
his century, he did
Yeah.
that. And most of the commentators who are around my vintage were saying, "We don't get it. Like, what
You don't get
does
it.
that mean?" And one of the commentators had kids, and they go, "Oh, what? You haven't seen the 6, 7 thing?" And I said, "No." Like, what, can you explain it to us?
Yeah. And he
That
was
was
like,
my
nah, don't
introduction to
know.
it as well.
Yeah.
The whole 6, 7 thing.
But
But
apparently that's so 2025 now, Darin.
was
So it was, yeah.
it?
Anyway, I won't go into it. My kids were very concerned about the great meme reset. As 1 January came around, I was like, I've got no idea what you're talking about. Anyway,
Yeah,
I'm
we'll
gonna I'm gonna
stick.
bring us back, Darin. Bring us back, and just
Yes, yeah,
say,
got to do that.
on balance, and I think all of this, like super, like you said, it is not simple. There's so many different puzzle pieces we all have to move around, and it really highlights the importance of people getting professional advice because I mean, we do this every day, all day, every day, and it's confusing. And you've got to every time I'm checking my legislation to make sure that it's, there will be some little nuance in there that will be annoying. That for you like, oh, you can't implement that because of this, or oh, great, I forgot that you triggered your bring forward period a couple of years ago and didn't fully use it. Let's use that and then do this, and that's a good outcome. So it's like there's so much to cover and they interact so like substantially as well. I mean, we haven't even spoken about the estate planning implications of any of these things because that's something that needs to be considered when we're implementing any strategy. So I think it's just so important to get that professional advice and run the numbers and be critical of the numbers. And the reason why I say that is things like carry forward concessional caps, what's available, what their transfer balance cap that they might have available, and what their indexed amount is, the non concessional contributions that they've made historically. That information is available on the tax portal. So, but it might not be 100% correct. So,
No,
it's a good
yeah,
starting point, but I would always critique that information because if again we're sitting right now and it's March/April, a lot of self-managed super funds that have lodgement due dates in May, they haven't done the 2025 financials. So you don't have that complete contribution history to then be able to make a call and say, right, Darin, put in 360. It's like, whoa, hang on, you triggered it last year, like all of those things. So it's important that we double, triple check. Again, the implications of going over are not completely heinous, but there's still implications. There's, especially with non-concessional, there's tax implications there because they'll have an associated earnings amount that's included in their assessable income, et cetera, et cetera. And I've seen situations where, so with the non-concessional, you don't have to meet the work test up to age 75 and 28 days after the month of your 75th birthday. But that doesn't work in terms of using a bring forward period with that 28-day, the month that 28 days after the month of your 75th birthday, if their 75th birthday is in June. So you can't say, right, well, Darin turns 75 on the 5th of June. Let's before 28 July put in 360 and or 390, sorry, would be what we'd be able to do. And that is because the test for the bring forward is the age at 30 June. And because Darin's already 75, you've got to be under or 74 or younger. So if you're 75 at 1 July, you're out. And so you could only do then a single year amount. You couldn't do the 390. Anyway, then like all those little, there's so many little nuances in there but then the opportunities are substantial. So hopefully with, that indexation comes with it, revisiting client strategies, really trying to add value and the importance of being critical of the numbers and to make sure as much as possible we get it right.
Such a shame, Gemma, that there's no such concept of as like the Force in Star Wars,
I
which would
know.
override all of this, and we could rely on that and use our
Yeah.
instinct, just listen to the
Instinct.
Force,
Yeah.
use the
Listen to the
Force.
force. Yeah.
Can't do
Use the
that,
force, young
unfortunately.
Padawan. Exactly.
No,
That's exactly right.
can't do it.
So you squeezed in our Star Wars reference. Good
I
work.
did,
Good
but
work,
I didn't.
Darin. I can
I
always
didn't get a
rely on you.
Simpsons. I didn't get a Simpsons one in today.
No, but that's
And I
okay.
couldn't. I couldn't work in a Simpsons one today. So
No,
apart from
I think we
maybe
did
you
pretty
can't
well.
use the excuse if you have an excess contribution, you can't use the uh, Bart Simpson excuse of I didn't do it. It wasn't me. Nobody saw me do it because
Yeah.
that's not going to fly.
Unfortunately,
Just on the
it's not going to fly.
MyGov, just on the
Yeah.
MyGov thing, I actually wrote an article this week about how sometimes it will not take into account any carry forward uh, concessional contributions that you might have used after a 5-year period or something like that. So the
Mm,
so the record itself that you're seeing on screen is not actually complete. So if
yeah.
you just looked at it on screen, you might think that, oh yeah, that's pretty cool, but it's actually inaccurate. So the message was, look, you can't just rely on one source to
No.
um to have a look at these things. You've got to make sure that you've absolutely got this buttoned down
Yeah.
to avoid any inadvertent compliance issues.
But I would
Like
still
those.
start there. I would still go
Oh
to
yeah,
the
yeah,
MyGov or the portal.
yeah.
Now, obviously, the challenge with that, if you're a financial advisor and you don't have access to the portal, I mean, that's an ongoing issue in terms of being able to get that information. So if you don't have access to the tax portal, obviously requesting the information from the client's accountant, they might not even have an accountant because they've only got super and they don't really have other assets outside or whatever that might look like. And so they don't do a personal tax return. Or they do, but they just get refunds of franking credits and blah, blah, blah.
Mm.
Anyway, so MyGov is a good place to start. But then again, like be really, really critical of the information that's coming through because you just don't know whether, it's garbage in, garbage out, or we have seen situations where it hasn't been garbage in, but it has been garbage out. So again, being super critical of what that looks like. Because you just don't want to, again, if it gets stuffed up, there's mechanisms to deal with it. It's just not as good. Also, you then fully invest that money. And like you were talking about earlier, you get a notice saying you've got an excess, and that has to come out of super. Then that's got to be in cash because it's got to go to the tax office. There's some tax implications, and it all sort of flows on from there. So we just want to avoid those things as
Yeah.
much as possible.
Basically, prevention's better than the cure, isn't it? It
Absolutely.
always
So,
is
what is
better
it?
than the cure.
Measure twice, cut once.
Yes, correct.
Yeah.
Well, Gemma, on that note, I think we're going to wrap up today's session.
Yep.
We've discussed a whole lot of things, and we've probably apologies because we've probably jumped around a lot
Yeah.
because
But
of the
people
different
are used to that,
contexts.
Darin. They're
Yeah,
used to
that's
that.
that's true. That is our style
That's our
to jump
jam.
around and go off piste a lot.
Hmm.
pretty relevant now, seeing that we've just had the Winter Olympics as well to
Yeah, look at that.
make that comment. But yeah, we've run out of time. So again, just like to thank you, Gemma, for providing all your knowledge as usual
Thanks
for
for
the
having me.
podcast. It's been really good. Thanks also to SMSF Property Valuations for their continued support. I met Michael from SMSF Property Valuations at the national conference, so that was really good to connect with him. Thank you also to my production team who put these podcasts together and make sure that they're published across all of our mediums. But most importantly, thank you to you, our listeners, for joining us. We hope you get a lot of information out of these podcasts, but more importantly, we hope you enjoy listening to them as much as we enjoy bringing them to you. Until then, we look forward to seeing you for the next episode of the Cross Country Super Podcast. And obviously, until then, travel safely and bye for now.
Bye, everyone.